The governing body of London's financial district is opening offices in New York and Washington, D.C., in a push by British policymakers to forge stronger international financial ties after Brexit. The City of London Corporation, which runs the capital's so-called Square Mile, set its New York outpost open on Monday, with the Washington office set to open on Tuesday. The organization said its aim was to help Britain foster closer financial regulatory cooperation with the United States, improve market access for British firms, and attract greater United States investment into Britain. Post-Brexit, the business bandwidth between the US and the UK has accelerated, which made it incumbent upon us to have a physical office to keep these connections going, is what Lord Mayor Michael Manelli, ceremonial leader of the City of London, told the Reuters news agency. The UK is the second largest investment management center outside the US, with 15% of global assets under management, and there is scope to grow that further by providing better business connectivity to London, as Manelli said. I have my doubts here, but the move comes as Britain pursues a raft of reforms designed to boost capital inflow and regain lost ground to rival financial centers after Brexit largely cut its access to one of its biggest markets, and that's the European Union. British lawmakers last week criticized the package of reforms to date as a damp squib, arguing they were yet to make a substantial impact. Britain's Financial Services Minister Bim Afolami welcomed the City of London's office openings in the US, adding that the British government wanted to encourage closer trade and investment between the two countries. But there still are financial bad news coming up, Pay growth has eased back at the fastest pace for 2 years, while vacancies drop further in the longest run of declines on record, and that is according to official figures. The Office for National Statistics, the ONS, said private sector regular earnings, excluding bonuses, rose by 7.3% in the 3 months to October, down from 7.8% in the previous 3 months. This was the steepest fall in earnings growth since the 3 months November 2021, and marks a further pullback from a record high of 7.9% in the summer. But despite easing back, pay growth outstripped inflation at the fastest pace for more than 2 years. To account. In further signs of a weakening UK jobs market, the ONS said the number of vacancies fell for the 17th month in a row, down by 45,000 in the 3 months to November to 949,000. That's the longest period of decline on record. The rate of unemployment remained unchanged at 4.2% in the 3 months to October, but more real-time figures estimated the number of workers on UK payrolls fell by 13,000 in November to 30.2 million. ONS Director of Economic Statistics Darren Morgan said about this, "Job vacancies fell again, and this is now the longest period of decline on record, longer than in the immediate aftermath of the 2008 downturn. Nevertheless, the number of vacancies still remains well above its pre-pandemic level. While annual growth in earnings remains high in cash terms, there are some signs that wage pressure might be easing overall. However, as inflation has been falling more quickly, pay continues to grow in real terms." Chancellor of the Exchequer Jeremy Hunt said it was positive to see inflation continue to fall and real wages growing. But the data suggests the jobs market is stalling in the face of a more uncertain economic backdrop, with firms not hiking pay as fast and fewer vacancies there to be filled. The slowdown in wage growth is seen reinforcing the case for the Bank of England to hold off from raising interest rates further. Policymakers are widely expected to keep rates unchanged at 5.25% when they decide on this week, with many forecasting the bank may look to start cutting rates in 2024. The bank is watching wage growth intently, with the recent record highs having been a cause for concern in its battle to bring sky-high inflation back down to the 2% target. Jake Finney, an economist at PwC UK, said, "Signs of labour market cooling will provide some reassurance to the Bank of England Monetary Policy Committee." With no major surprises in the economic data over the past 4 weeks, rates are likely to remain unchanged. And Samuel Toombs at Pantheon Macroeconomics said that the unemployment rate is set to drift higher over the coming months. Current jobs data is being collated using extra data sources to estimate the figure due to low responses to the labor force survey. And Mr. Toombs said when revised survey data is available from next spring, he expects the rate of unemployment to rise to around 4.8%, which would further strengthen the case for the MPC to begin to cut bank rate at or shortly after its meeting in early May. The ONS data also showed there were 131,000 working days lost to industrial action in October, with 49,000 workers were involved in strikes, though this was the lowest number for 4 months. According to the latest figures, the rate of UK employment remained unchanged at 75.7% in the 3 months to October. The British economy got off to a weak start in the final quarter, though. In October, the gross domestic product, the GDP, shrank by 0.3% compared to the previous month, as the ONS Statistics Office also announced in London on Wednesday. Analysts on average had expected a decline, but by only 0.1%. In the previous month, the economy grew by 0.2%. According to the data, developments in October were consistently weak. Service provider activity fell by 0.2% and industrial production fell significantly by 0.8%. In the construction sector, economic output fell by 0.5%. The British pound reacted to the data with losses against the US dollar and the euro. And Britain's telecoms regulator also said on Tuesday it wants to ban inflation-related price increases in customer contracts. The Office of Communications said most major phone, broadband and pay TV providers in the UK currently include mid-contract price increases linked to future inflation rates. These and other percentage increases create uncertainty among customers, and the office wants to ban this practice. In my contracts here in Germany, I don't have that. Instead, Ofcom wants telcos to inform the customers in advance in pounds and pence of any price increases included in their contract. We have tentatively concluded that mid-contract inflation-linked price increases may cause significant harm to consumers by complicating the purchasing process, limiting consumer engagement, and thereby making competition less effective, as Ofcom said. These clauses also unfairly require customers to bear the risk and burden of financial uncertainty caused by inflation, which has a tangible impact on their ability to manage costs at a time when household budgets are already stretched and the borders are strained. The regulator said it would deliberate on the changes until February 13th next year and then publish a final decision in the spring. But as I said, I have a 2-year contract on all of these with my provider, and at the end of the contract, in the last month, I will pay exactly the same I paid in the first month. So I don't know anything like these inflation increases during a contract. So that is not a thing. But if you want to see something else right now, the next video is right here in the end screen. I'll see you there. I'll be back.